90% of traders lose 90% of their money within 90 days. And when it comes to the rise of prop firms, well, people are blowing accounts at a faster and faster rate because it's not their own money. And myself included, being one of those traders that was blowing accounts 9 years ago to transitioning to my life now where I've made millions of dollars from the market. I've publicly documented a track record and I've spoken to some of the best traders in the world through my podcast. And through all of that experience, I need to tell you that the reason you are blowing your accounts is because you don't understand liquidity. In fact, it boils down to this: if you cannot see the liquidity, you are the liquidity. So in this video, I'm going to show you a specific price action model, something that you will see time and time again. And within this specific price action model, you will see there is 5 phases, and it's crucial for you to understand the difference between what dumb money is doing, which is entering on the early phases, versus what an intelligent, profitable trader will be doing, which is entering at the end of these phases once you have true confirmation. And it all boils down to this: institutional and smart money. I'm not talking smart money concepts. I'm talking the big players in the market. They seek and destroy liquidity. And if you don't understand their intentions, you don't see the liquidity that they are going for, you will always be on the wrong side of the market and continually hitting stop loss. And my goal for this video is, once you understand this price action model and the principles behind the 5 phases, you'll be well equipped towards profitability. You will certainly increase your win rate, and in fact, you'll even increase your risk reward ratio. So let's jump right into it. So as you probably know, a very strong foundation to look at the market from is market structure. If you can understand trends, if you can understand intentions of where price is going based on a few simple phases, for example, you'll have bullish, you'll have bearish, you have consolidating. Within that, you'll have accumulations to go bullish, you'll have distributions to go bearish, and then you have reaccumulations to continue going bullish and redistributions to continue going bearish. So within these market phases, how they'll be represented is market structure, where you have bullish impulses, bearish impulses, retracements or complex pullbacks, and zones of consolidation. So these are the multiple phases that we have, and the driver of all of that, by the way, is liquidity. But first, let's put some foundations in for this price action model that we're going to develop. So starting off with price action in a trend. So like this, we have a bearish market structure piece. But you know, within this bearish market structure piece, you're going to have internal price action, where it's going to be internal bearish price action. And then once you arrive to the lower low, you're going to have this break of structure here, internal bullish break of structure, internal bullish price action. And where is this going? This is going as a complex pullback into some form of supply. So we're going to go to some form of internal supply. The external structure is this. This is the high, this is the lower low, this is the lower high, this is the lower low. So that's external structure, and that's part of the trend. So that external structure we can actually mark out and say these are our external structure points. These are the ones that enter new territories. When a high leads to a new low, that is a new external leg. That's a main push. When this high leads to a new low, that's a main push. For example, here where we have this is bearish price action. We are having internal lower highs and lower lows, but we are still within the range. We are still within the range of the last push. So if we see this is the last main push from lower high to lower low, anywhere below this high and anywhere above this range is going to be considered internal price action of this main push. So every main push decides a dealing range, a price action range, and you can mark the highs and lows. So when we see price over here has made a new lower low, it's broken out of the range and made this newfound territory lower than the previous low. Now we've decided a new price action range, decided by that external main push. So as long as we are inside of that external main push, anything internal here is internal price action, internal trends. And we need to know the difference between internal price action and external price action, because that's going to help us understand destinations, where price is going. For example, if I zoom in over here, we can see that we have internal price action where we have this lower high, but it's not a new lower high because this is internal to our range, makes an internal lower low. This one happens to break structure. So we know that this point of interest is going to be our decisional. I'll get into that in just a moment. But I'm also interested in this internal price action where we have internal lower high, internal lower low. This is all part of the main push to break the new range because it made a new low compared to the previous lower low. So we have entered a new territory, and we can see that this is the last lower high that made the ultimate lower low. Now from here we see a switch. We see price goes up and we have a bullish break of structure. This last lower high that made a lower low went on to make a higher high. So we know we had a transition. Now, just because we had a bullish break of structure and then we found a higher low and then a higher high, does this mean automatically it's a bullish market? We should only buy and the next thing is a bull run? No, the market is within phases. So when we zoom back out and we see context, we say, yes, right now price action is bullish in this internal trend, but it may be forming a bigger picture because right now we have a bearish leg from lower high to lower low. Maybe this internal bullish price action is only to come to form this decisional, or maybe the extreme to form a lower high, maybe all the way to the extreme, maybe bounce over here, but eventually to go on to make a new lower low. So that external trend will continue because we have the narrative of lower highs and lower lows on the external time frame. So anything internal is short term, and we have to understand the destinations. So this is how you're going to have price action reads. This is simple market structure for now. So once we can identify a decisional and an extreme, where this is the origination point of the move, this is the highest point within that main push, that becomes our extreme, and the decisional is the one that ultimately led to the break of structure. These sellers are the ones that actually broke structure, so that forms our decisional. Anything else is just weak supply, can be liquidity. And by the way, how do we know if it's going to be the decisional or extreme? This internal trend will tell us. If we see price comes to this decisional and then doesn't form a lower low, for example, from this point, it just grabs the liquidity here and then continues bullish, a bullish trend, and even breaks this point, is giving us signs based on the inducement of this liquidity and internal bullish price action that is going for that extreme. Conversely, if we see price reacts off this decisional and then gives a small bullish push up and then makes a new lower low, we've now established not only our external trend, which is lower high to lower low, we've now established an internal trend, which is high, lower low, could go on to make a higher high because this is the bullish trend. It could go on to make a higher high, but it fails. It fails to make a higher high, makes an internal lower low. So therefore, we have established a low, lower high, lower low. We've established a bearish internal trend, and that bearish internal trend could be a follow through from this main bearish push. We could be now forming a new bearish push to make a new lower low. So that's how you decide between internal structure and external structure. And you need to understand these important inflection points where we have a price action read that could just be bearish from here, where we have internal lower highs and lower lows. And then when it ultimately makes the new lower low, we say new bearish push, and then we change our range because we know now this is the high of the range and this is the low of the range, and we have a new dealing range once we make a new low. And then when we analyze exactly what happened, we say, okay, main push bearish, lower high to lower low, complex pullback bullish, internal bullish price action to arrive to a supply level that's in a premium, one of our preferred supply areas, decisional or extreme. And once we had that reaction, price then continued to give a new bearish market structure, make a new low. So that would be one very appropriate read. But at the same time, it's not the only read, because we also see price could see this as liquidity. We could have an inducement of this level, and this inducement over here that looks like a lower low off our decisional could actually be a run of liquidity. And we could actually see price tap into that same area, come into this same area, and then go towards that extreme. And once it's tapped into that extreme, then it could go on to make that lower low. So we need to understand there are certain areas where price is in the same place over here and over here, whether it went bullish in the end or whether it went bearish in the end. These are known as inflection points. Let me mark those out for you. There's an inflection point in orange there, and there's an inflection point in orange over here. Let's zoom in and analyze the range where we have from this high to low. How do we know it's a high to low? Because we had a break of structure. The last higher low that made the higher high went on to make a lower low. So we've established a new range, internal range, because it's internal to the main push. But from here, we have the high of that range and the low of that range. Inside of this area, before it breaks lower and we know it's going to be bearish, and before it breaks higher and we know it's going to be bullish, inside here, these inflection points, this is where manipulations can happen. And this is where buyers and sellers take losses because they just go with market structure and they pick a side as opposed to understanding intentions. And if you don't understand intentions, you're just taking market structure as a foundation and it's a good one, but in the end you're just flipping a coin and saying, oh, because we've had a break of structure, I'm going to sell here because it's bearish. And sometimes it'll play out. And then when you read it market structure wise, you say, yes, it played out because we had an internal break of structure. And then other times you might be saying, okay, the price has reacted over here. We've seen a liquidity run. We had an inducement. We had a bullish push out. We had an internal mitigation, and then I went on to buy. And then you take that and you say, yes, it worked because I saw internal bullish price action. But what happens when you take losses? You need to understand what's the difference. What's the differentiator between when do you buy and when do you sell? And the key to all of that is an internal price action, liquidity, and intentions. And that's what we need to clarify in this video. So now we have established a few important things. We've understood what is a main push, external structure, a high that makes a new low, or vice versa for bullish. Once we've understood that, we understood the internal price action points. That is internal trends. Internal trends are short-lived trends because they're trying to fulfill a purpose. For example, they're going to do the complex pullback, that retracement, to hit a supply or grab some liquidity. And then how do we know when that internal structure is turning towards the external structure, meaning a new lower low is happening back to the external? We see a shift in our internal structure. We see internal break of structure over here, internal structure of lower high, or internal structure of higher low to higher high, goes on to make an internal lower low, and then here it can still be bullish when it fails to make a higher high and then goes on to make a new lower low. Then we have a direction. And why does that work? Because we broke the range of the internal main push. This internal high that made a new lower low internally, this internal push decided a range for us, like so. And when that range was broken, when we formed a new lower low, when we had low, lower high, lower low, we broke that range, we formed a new lower low. Now we know it makes sense to sell, and this position over here, it makes sense to sell after we break the range, or vice versa. Let's say we break the range over here, we break and make a higher high, then we know that it makes sense for price to come back over here, and we look to buy until we arrive to this supply area. So it's actually quite important to understand, because this area becomes a demand area and a place we look to buy from until we complete that retracement towards that supply. Once we have a breakout of this structure point when form a new higher high, then the next thing to do is wait for the retracement and find buys in this demand area, because this is the higher low that made the higher high and broke the previous range of this to this. Now that range is broken out, I see as bullish, and then I look to buy. That's what market structure traders are going to be doing. And it's going to be the same the other way around. This area right here is going to be a great place to be selling from. Once I have seen price break from this range, the previous low of the range, once we break through that range, then I find the appropriate supply level, that previous lower high that made a new lower low, created the new range for us from here to here. Now I want to be selling within that range once again, and these buyers no longer make sense. So internal structure leads towards external structure. This is a great foundation, and a lot of the time you need to rely on this because it's the best thing you have, but you can't rely on that alone, because that will lead to also a lot of losses, because everybody can see this. Everybody knows what this is, and therefore there's liquidity all around. And when there's liquidity all around, there will be stop losses and therefore manipulations, and therefore you're going to be taking loss after loss, and you'll be left confused because you'll be thinking, I did the right thing. I followed market structure. I followed the plan. I followed trend. All of these things are good. They're just not good enough. And we need to therefore layer it with more important things that will improve your win rate, improve your risk to reward, and overall turn you from a non-profitable trader towards a profitable trader. So now that we've summarized the main points of what price action could look like and overall destinations, let's get into a few more details. So now it's time to understand liquidity. And when we get to this portion, when we are within our external range that's identified and then internal range that's identified, this is where a lot of people's lenses are going to be. And therefore, if price is arriving to the supply level, naturally people are going to be looking to sell. So when you see a rejection of this level, people are going to be starting to sell over here, and it might even give a reaction, and maybe it doesn't even break the low. Let's say we're now consolidating in this level. So as we spoke about at the beginning, we have market phases, and the market phases can be a bearish expansion, a new lower low, that's a phase of the market. Then you have a bullish retracement, that's a phase of the market. Then you have a consolidation, which is range bound between this internal range where you have lows and highs, and these consolidation zones are usually where you have your accumulation, distribution, reaccumulation, redistribution, and depending on where you're sitting in the market is which one is going to be. In this case, because we are having a bearish push and we're on the way to have a new bearish push, this is going to be more likely a redistribution pattern. So this is what other people are going to be looking at. But let's look at it from more lenses. Number one is going to be the Fibonacci trader, where it's going to be seeing from this swing high to this swing low. They pull their Fibonacci and they know at exactly the 61.8. The first reaction was where? At the 71 fib. And then around the 61.8 fib, they see rejection 1, rejection 2, rejection 3. We know that in this area around the 61.8, especially when you're seeing rejection, double top, what do we know traders are going to be doing? They're going to be selling on that double top rejection, seeing that as a resistance level, seeing a rejection of the Fibonacci level, and they're going to be looking to sell, which is okay. That's a strategy. But what do we know for sure? We know for sure around this area there's going to be their stop losses. So that's going to be the stop losses of who? Fibonacci traders, support and resistance traders, double top traders, therefore pattern traders, and there's even going to be market structure traders. So a lot of traders are going to be involved in that area. So we have to be aware of their liquidity. Next, we are going to be seeing our wonderful trend line traders. And these trend line traders, they're going to be interested in the first touch over here, then the establishment with the second touch, and then when we see third touch, fourth touch around this area, we know that the trendline traders are going to be looking around this area looking to sell, and therefore we know that their liquidity once again is going to be around this area, around the same as the other traders, maybe slightly lower because they might be taking internal structure. They might be doing a Fibonacci over here, so they might be entering on the 61.8 fib over here. They might be taking lower time frame level of supply and really entering here, so they might be having their stop losses even there, and that would be liquidity of certain trendline traders. Now we also have to consider, let's say, EMA traders. They have indicators. Their indicator is going to be flowing around this area of consolidation, so therefore people are going to be seeing price coming in, respecting that indicator, hitting the Fibonacci, hitting the resistance level, hitting the supply zone, more stop losses in that zone based on an EMA, and the list could go on. There's infinite amount of liquidity that there is here. Now what happens when price starts to go to the top of the range? Let's do it in another color so we can clarify it. Let's say now price is pushing out, and in this blue we're seeing prices breaking a little bit higher but still within the range. We're still inside of our internal range, so nothing has broken yet. We are still within the regions and limits of our internal range based on this lower high that made a lower low internally of this main push, the external range, which is lower high to lower low. We can also be seeing that the people that were in this area, maybe they're already taking their stop losses, now resistance double top, and there might be a liquidation of these traders, there might be a liquidation of these traders, maybe these traders are still in, but there's various forms of liquidity. But more importantly, we're also enticing behavior. As we bounce around the range, people are going to be seeing whatever they want to see. So for that reason also, we have to appreciate the bullish narrative, and that could be, number one, so the traders might see this low area as a liquidity pool, and therefore this could be a sweep zone for them, where they see this as a smart money level. They could be seeing that as a smart money level of demand over here. Why? Because we had equal lows right here. We can mark it as liquidity, equal lows. And then we had a run of liquidity sweep right there. And then it led to this bullish price action. So they are going to be seeing the market a little bit differently, because they're going to be seeing sweep of liquidity of these lows and of this structure point, maybe even arriving to a higher time frame demand level. Okay, because that can also happen, and they're going to be seeing it from another lens of, we had a sweep of liquidity, bullish push out. This is the bearish complex pullback retracement. Once we arrive here, we're going to go on to make a new higher high, and we're going to break the external range bullish. And if they're focused on the market like that, from that perspective, and we can't invalidate it because at times that can also play, we need to understand what are they going to be looking at. So first of all, we can do a Fibonacci from their low to their high over here. And we can see prices hovering around the 61.871 fib at this level. We are arriving to their demand area. We are also fulfilling their narrative. They're going to be seeing this 1, 2, 3 touches as a support level. So they're going to be having their own reasons to enter. And then you can also put their trend lines of 1 touch, 2 touch, 3 touch around this area, and they're going to be loading up on buys. So when we have all of that in place, they can have that internal support level liquidity. We can have liquidity over here below this demand area. So we can already see there's starting to be more and more liquidity pools, especially when I add the fact that this did not make a higher high, this did not make a lower low, this is internal to this range, and then we have a push out over here. So although it's not broken this range yet, although it's not broken the internal range, we've still had this level break out. We've had a bullish push out. So certain traders are going to be seeing this as a level of demand, and therefore what are they going to be looking at? They're going to see this bullish price action push up, coming back for a retracement. They're looking to buy over here to go towards potentially this extreme, or if they're fully bullish, maybe even make a new higher high based on this smart money zone on a higher time frame demand supporting this level, and therefore we can plot their liquidity here too. So as you're starting to see, we have multiple forms of liquidity in a zone of consolidation at the high of the internal range, at the low of the internal range, where we have support and resistance, trendline traders, Fibonacci traders, market structure traders, a lot of involvement. And therefore that's how the market, the smart money, the real smart money, not smart money concepts, that's how they invite traders in. And because it's intentional that they're showing people what they want to see, inviting in their orders, and then liquidating them later. It's a process of inviting liquidity and taking it out. So therefore that word is inducement. You induce them to take action, and then you induce them out. This is a form of real manipulation, and this goes beyond just market structure. So we have to understand both of them to have full clarity in the market. So it might look like there's a lot going on, but this is the reality. People have their own opinions and their viewpoints on the market. So just to summarize it, we have in orange the trend line liquidity, and therefore when we have a breakout over here, what are those traders seeing? The same break. They're going to come back for a test, and they're going to look for a higher high. So now we've invited more and more liquidity because once we have played the range, more traders are getting in on a break test continuation, maybe even inside of here. And therefore, they're going to be buying on a test of that trend line, maybe stop loss at the low over here, looking for price to come higher like so. That could be one example. Another example could be somebody saying, okay, we've had a bullish push. Let me find a Fibonacci retracement over here. So they're going to be waiting for a reaction on that Fibonacci level right here, 61 to 71.8. And they're going to be putting the entries, let's say over here, same stop loss at the low, waiting for that new high. I'm going to delete that just for clarity. And then what else do we have? We have this demand area that people are going to be trading because they saw bullish push out, breaking this previous high. We've now had a higher high. People are going to be waiting to buy on that demand area. Where they're going to be entering? Right over here. Where is their stop loss? Right over here. And they're still looking for that same high. So you can see price just going a little bit higher into the range, invited trendline traders that are breakout traders, Fibonacci traders, market structure traders, people that are seeing a support level. There's more and more liquidity as that consolidation develops. It's very important to understand what's going on in these zones because that's exactly how the market is going to invite traders in, invite orders in, invite liquidity in, and therefore eventually take them out. I'm marking all of these out so you can see that these are the Fibonacci levels for the bearish. These are the Fibonacci levels for the bullish. And we can see how they really overlap where we have this zone over here, a narrow in pip count zone. We have double top traders. We have market structure traders. We have Fibonacci traders of this whole main push from high to low. This is the Fibonacci levels. And then we have the same for the buyer side. So although this looks like a mess, this is where we really need to understand where the liquidity pools are. So I'm going to clean it up and hopefully you can remember exactly why we put each thing there, just so we can leave it with price action. So as we continue on now, we need to understand where the manipulations are going to be and how they're going to look. Let's say, for example, now price gives a bit of a pullback, gives those trendline traders, Fibonacci traders that were buying from this bullish breakout, waiting for the test. Let's say we give them an entry, we invite them in. And now price is sitting over here. Now we've had more development. Just one single push up is done a lot. Number one, we've taken out that liquidity of that supply zone over here. We've taken out the liquidity of everyone that was trading this double top. Liquidations have already happened. We've arrived higher up to a supply level. So what are other traders going to be seeing? We've broken this internal range. That internal range is now gone, where we've developed a new range now from here to here. So with that new range comes new activity. So we need to now reassess this. One small push, what has it done? It's taken all of this high liquidity. What can we see? We've had these equal highs with this 1 touch, 2 touch, 3 touch. We've had this zone that was seen as equal highs. Now we've had a push out. So what is happening over here? People are going to be seeing this zone and they're going to be looking to buy. So we're going to be seeing that demand area of higher low to higher high. Buyers are going to be there. We're going to be seeing 1 touch, 2 touch. We're going to be seeing people entering on this trend line. What else are we going to see? Potentially Fibonacci traders that are going to see that impulse. They're going to go from swing high to swing low. Their entries are going to be over here. So we can see a lot of people are entering in this zone because they are seeing break of that internal range, forming a new higher high, and a new internal range is formed. In fact, that's the internal range right there. So that new internal range is inviting new behavior, new people to get into the market. Therefore, more and more liquidity is around this area on the trend line, Fibonacci, market structure, and so forth. Now, what else are we going to be seeing? From a smart money perspective, smart money traders are going to be seeing equal highs, run of liquidity, and supply zone. They're going to be looking to sell. So if price comes in now and starts to give internal bearish price action like so, they're going to be entering on sells over here. Why? Because they're going to be seeing a bearish trend line. They're going to be seeing internal lower highs and lower lows, that internal market structure. They're going to be entering sells, and therefore their liquidity is going to be around here. So we can start to see in this compressed zone of this internal range from here to here, we have sellers interested, buyers interested. So what has this done? The market has now, with one small push, invited so many types of buyers, from market structure to trend lines to Fibonacci to smart money, and all of these people are getting into the market. Now that we are sitting here and we know that smart money traders are going to be getting in based on this zone, and we know where their stop loss are going to be, and price comes here, invites in those buyers. Another form of consolidation. That was triggered in all of the buyers that were interested here. It's triggered in all of the sellers that were interested here. And this is where the market counts, because now smart money traders are entering off that level. Demand, market structure traders, Fibonacci traders, trendline traders are entering off that level over there. Now, this is where important things happen, because a lot of smart money traders are going to be seeing that very simple equal highs, run of liquidity, bearish reaction. They're entering sells on this zone. So even smart money traders might be a victim to smart money traps, where they get into that reaction and then price takes them out. Okay, price comes out for one more inducement, and maybe price is just going towards that extreme supply, and then right after that, the story can be complete where we have a new lower low. Okay, so if a price action model happens like this, although it's very easy to see in hindsight, you say, oh, it's very simple. We had a high in the market. This made a lower low in the market. We had bullish complex pullback. You overlook all of the details. Price went to the extreme into the supply zone, made a new lower low. Hindsight makes it look so simple, but the reality is the intricacies of every single day. People are getting in and out of the market, taking stop losses all the time. So we need to read those details to understand intentions so that we can really capitalize on it, because we could be buying at times, selling at the times when we see control. How do we see control? If you've seen my videos, you know my trinity, my important trinity, which is inducement, lower time frame confirmation, time of day. If you combine these three things and you understand rejection models, you understand momentum, you understand what volatility looks like through large bullish candles, imbalances. Once you start to package all these things together, you can be buying and selling all day long in these ranges, and whilst others are taking stop losses, you are actually capitalizing on it. But to overlook all of those trades for now and just focusing on the key pivot points, where I want you to focus on for this price action model is to understand the last key point. When this internal range broke for one last time and formed a new internal range, like so, and we've come to the extreme of the external range, we're arriving to that final destination point. We can see a lot of liquidations have happened. These areas liquidated, these areas equal highs liquidated, this supply zone liquidated, smart money zone liquidated. Why? Because the smart money traders were seeing equal high run of liquidity and they were selling in this zone, so their liquidations have happened. And you know, for example, trend lines, they always change, where you have one touch, two touch, three touch. So you have a trend line over here, then it's liquidated by this portion. So then you reset the trend and you say, okay, this is my first, second, and then this is the third touch, and that gets liquidated. And then you have another area over here, say, oh, readjustment, first touch, second touch, third touch, oh, another liquidation. You move it over here, and you say, oh, first touch, second touch, third touch, another manipulation. So you can see trend lines can actually be quite unreliable. Even this internal trend line got taken out, let's say. When you start to recognize these price actions, you'll see these things are happening constantly. On every time frame, on every move, there's people getting in and out, liquidated on every strategy. But the more interesting one is even the smart money traders, seeing equal highs, run of liquidity, even they faced a smart money trap, that smart money inducement. And when you start to layer it from another perspective, which is this could be our Asia range, Asia high, Asia low, this could be our Frankfurt reaction, Frankfurt trap, and then London open arrives into our supply. So we see a smart money trap at Frankfurt and an inducement into our extreme supply, liquidating everything that was here in our London open. This is where our actions take in. So if we can align London open into this premium supply zone with a mitigation, and we see a very simple price action model, for example, price is bullish after that smart money trap, internal highs and internal lows, internal high highs, internal high lows. And then over here, this is where we have that change. We have that internal break of structure, lower high to lower low, and then a new low in the market made. So even on the smallest of levels, we saw an internal range where if we zoom right in, we saw that last higher low that made a higher high, broke that internal range right here, broke the low of that range to make a lower low, and then that's where our entry can be. We can be selling on that break of structure on a lower time frame, on a London open after serious inducements. For example, we have induced a smart money trap. We've induced that resistance level. We've induced that smart money zone. We've induced multiple trend lines. We've induced market structure traders. And when this low is happening, when this trade is playing out, it's targeting all of this liquidity we found. That demand area taken out, the Fibonacci area taken out, all of these trend lines and etc. taken out, and even Asia low liquidity taken out, this demand area taken out. So we see these areas where price might give false reactions. Price might come in, let's say, to this demand area. Certain people are going to be seeing bullish impulse, price coming back, price might give them a false reaction, buyers are going to be loading up, more stop losses, price will take that out too, and eventually it'll take out the whole zone. But when people look back, they'll say, oh, that's so simple, lower high, lower low, lower high, price made onto new lower low, and they'll say there's nothing impressive about that trade. It's not. You just combined a few things. You applied market structure, you applied liquidity and inducements, you saw lower time frame confirmation and time of day. These are simple things, but the key is if you avoid all of the losses in between, all of the losses in the chaos of this zone, that if you're just trading market structure, you'll take losses. If you're just trading supply and demand, support and resistance, you'll take losses. Trend lines, you'll take losses. Fibonacci, you'll take losses. Smart money concepts, you will take losses. The key is understanding real intentions of the market, real manipulations and real inducements. A lot of people could have taken this trade, but the real trader, the real professional trader, they'll know how to avoid all the chaos in between, because they know that when they take a trade, it's when it's going to count. After a significant inducement, a mitigation, completion of the liquidity cycle, structure cycle, lower time frame confirmations, time of day, when you add these limitations to yourself and you avoid all of the rest, you will be profitable. Because as I always say, a restricted trader is a profitable trader.